via WebEx from across the country, and a lot fairly locally as well, thanks to the weather. So today we welcome Mike Fratantoni, who's the Chief Economist and Senior Vice President of Research and Industry Technology from the Mortgage Bankers Association, Sam Cater, who's the Deputy Chief Economist from CoreLogic, and Wei Lee, who's the Senior Research Associate at the Housing Finance Policy Center at the Urban Institute. And you can read more about them in your handouts, which are located outside of this room. This was actually a very, very interesting talk because over the past 18 months, we've all three of the researchers have realized that there is really no good measure of mortgage credit availability. So what I'd like to do is sort of give a 2-second introduction to the problem that everybody is trying to solve. When you looked at sort of historical measures of mortgage credit availability, there were 3 of them. The first and most often quoted was the Federal Reserve Senior Loan Officer Survey. And when you look at this picture, what you'll notice is that it did a very, very good job capturing the tightening of credit conditions from 2007 on, but did a really lousy job capturing the loosening in mortgage credit standards from 2003 to 2007. In particular, that looks very, very flat. Also, the survey didn't recognize the importance of risky products in terms of actually being a loosening of credit standards, and in fact, the Federal Reserve didn't start asking about that until well after the crisis. The second measure of credit availability that is oftentimes quoted is the mortgage denial rate. This, using HMDA data, has a problem in that it peaked in 2006, 2007, when mortgage credit availability was actually very, very loose because you had a lot of less creditworthy borrowers applying for mortgages, and therefore the denial rate was higher. So that too is an intuitive measure of mortgage credit availability. And then the last measure of mortgage credit availability that is oftentimes used is the FICO scores. And the problem with this measure is it does a very good job, again, capturing the tightening in credit scores from 2007 on, but doesn't explain any loosening in the 2005 to 2007 period. Obviously, loan-to-value ratios, debt-to-income ratios, decrease of risky products are also contributed heavily to loosening credit availability standards. So basically, over the past 18 months, both Mike, Sam, and Wei have all devised indices that try to address this problem, and each of them today is going to talk about their indices, how they're constructed, what went into it, what the thought process was. Throughout the program, webinar guests are welcome to submit questions to events@urban.org and events@urban.org. Please identify yourself by name and affiliation when you submit your questions. And all material and papers from today's talk are also posted on the Urban Events page. So with that, let's get started. And the order is going to be Mike, and then Sam, and then Wei.
Lori, thank you very much for inviting me to do this. As Lori mentioned, I'm going to talk about MBA's contribution here, which was our Mortgage Credit Availability Index, which we first published in April of 2013, and it comes out monthly, typically in the second week of the month, reporting on the prior month's activity in terms of mortgage credit availability. In my talk today, I'm going to really have 2 sections. The first talk on really what was our motivation in developing this index, how is it constructed, what are some of the component indexes that we provide, and then the second portion really talk about some of the trends we're seeing once we have this index developed. And I completely concur with all of Lori's comments about really this was developed out of frustration with not really seeing clear signals out of the other data that was out there in terms of a summary measure of mortgage credit availability. So first I'm going to start with the background on our Mortgage Credit Availability Index. This is a joint effort. We rely on products from regs, which is a mortgage technology firm called their market clarity data. Essentially what it is a compilation of the underwriting criteria that a large number of investors, 80 to 100 different investors, have as an offering out to the market. That they are wholesale providers, and what they would accept from, in terms of an application from a broker or a closed loan from a correspondent seller in terms of credit standards. This is really meant to be used by a lender saying, okay, I have a borrower of a certain type seeking a certain loan, which programs do they fit into? So we're going to take that data and then using our approach, try to accumulate all of that information on available credit on offer from these wholesale lenders into a single index number. So that's the big picture idea. Before I get going, I did want to thank Brendan Zubrick, who's here, who's on my staff at MBA. He's been the principal analyst devised in computing this index every month. So thanks to Brendan. What were our objectives in putting this together? And again, this lines up with what Lori had said. We really wanted to measure both the quantity and the quality of mortgage credit that's being supplied to the market over time and for different segments of the market. Why do we emphasize supply here? Again, these are the terms of loans that are on offer through wholesale channels out to lenders across the country. Go back to your Econ 101 class, right? I mean, equilibrium price and quantity are determined by the demand and supply. If prices and quantities move in terms of closed loans, either in terms of rates offered or the types of loans that are being closed, you can't really decipher whether that was due to changes in demand or changes in supply. If we can provide information on what is happening to the supply, what terms are being offered by lenders, you can use that in combination with information and data on the loans that are being closed to really infer what's happening to demand. Without a clear signal on supply, you can't do that. We also wanted something, and again, because we have access to this all regs data, we know exactly what is moving the index over time. And in our press releases monthly, we identify very specifically, last month it was due to changes in max LTVs on jumbo loans, right? We can get that specific because, again, you're looking at this spreadsheet of underwriting criteria across these large number of investors. So we thought that was important. We think it's useful to our membership and to lenders and investors out in the market, knowing what's happening to sort of this industry benchmark in terms of credit standards and knowing where their own standards may be moving in relation to that industry benchmark. I got my start as a macroeconomist, right? So I think there's potentially some value in this in economic modeling as well, similar to what people have gotten in the past out of the Fed Senior Loan Officer Survey in terms of an indicator of what are overall credit conditions, how do they appear to be evolving in the market. And then the last part, again, connected to the fact that this is really a measure of the types of loans that are on offer, the measure of credit supplied. That really is a new source of data. Sam, others are very good about putting out what's the composition of loans that are closed, right? I think that's very, very valuable. We put out our application survey, so that's both a measure of demand and an indication of the composition of loans that are moving. We think this is really new information because it's characterizing the types of loans that are on offer. Okay, so what's the data? We have information on over 3,000 unique loan programs each month. This is across a large number of investors. Think about these as sort of credit investors, so 85 to 100 different investors. These may be lenders who offer a broker program, lenders who are correspondent buyers. It includes Fannie, Freddie, FHA, and the MIs, because again, these are folks who are staying out. I will offer loans or credit guarantee for loans that fit inside of this box, and they're defining this box along a number of dimensions. We then capture from that data a large number of attributes and list here what many of them are. Okay. That's the starting point. Then what Brennan and our group do is then pare that down to say, okay, but we don't really need all that information for the index. What we want to do is trace what does the external sort of edge of that envelope look like in terms of credit availability. So you're looking at term, they may offer term from 5 years to 30 years. From our perspective, in terms of what kind of credit's being applied to the market, that maximum term is really the interesting one. And same with LTV. For credit score, it's really the minimum credit score that they would take in. So we established that envelope based upon the whole set of criteria that are noted within that box. I mentioned in terms of the objective that we wanted to capture both the quantity of credit being supplied to the market and the quality. So ideally, when we were thinking about constructing this, if last month there was one investor supplying a 30-year fixed-rate full doc loan, totally plain vanilla characteristics, now there are two, we'd want to capture that as an increase in the amount of credit supplied. And we do, by the way we're calculating this. By the same token, if last month there was a 30-year fixed-rate plain vanilla loan, and now there's a no-doc, neg-am loan down to 500 credit score, that's a different dimension in terms of increasing credit supply to the market, and we wanted to capture that. So we calculate both change in this credit index on an unweighted basis and a weighted basis. In terms of the weights, this is just a diagram of sort of how do we go about thinking about the weights. So adjustable rate loans get a higher weight than a fixed rate loan. Changes by FICO, credit score, and LTV by occupancy type. So if you're offering a loan to an investor on an investor property, that's a higher risk than an owner-occupier generally, right? Documentation is a big one, right? A no-doc loan, you'd expect to have about a 6x impact on default relative to a full doc loan. So that is a very, very large factor. That's also something that has been almost completely removed from the market. So some have sort of asked, well, so this is sort of the secret sauce here is that transparent. If you were to ask, okay, where do these weights come from? They are almost entirely from public sources on measures of relative default in terms of lifetime cumulative default. So you might look at a rating agency criteria or look at historical data from the GSEs. And I also sort of started my career as a credit analyst at Fannie's. I've got some views here that have been leavened into this as well. But if you got a bunch of people like Lori and maybe some credit analysts from the MI in a room, they would come up with weights like this. So how do we do this? Again, we're going to aggregate across all these investors, both quantity of credit being supplied to the market and quality using these differential weights, and come up with an average risk score, compare it to that risk score in the base month. As I said, we began releasing the data in March of 2013. With that initial release, we had history back to January of 2012. Talk about that more in a second. And we set the base period accordingly. Again, what's sort of neat about this data that we have access to is we can split it in a number of different ways. So we do a total market credit availability index, but we've also been able to split out, okay, what's happening within the conventional space, what's happening within the government space. Conceivably, we could do what's happening in the conventional conforming space versus the jumbo space, and sort of differentiate that way as well. What's happening for fixed versus arm loans. We can cut it any number of ways and track that. To this point, we've only pulled out the conventional versus government split. Given sort of the different paces that are happening with GSEs versus FHA, this is an interesting piece of information to have. Right? Because not only are those programs changing, it's how are those changes being taken up by lenders in the marketplace. So with that, let me move on to recent trends. So this is an index. Our decision was to set it to 100 in January 2012 and then track that change over time. The way the index is devised, an increase in the index means more credits being made available to the market. If it goes lower, less credits being made available. And again, with each month, with each squiggle in level of index, we can point to specific changes in specific loan programs to identify what was leading to that change. Now, one thing that we've additionally been able to do is, working with the folks at All Regs, initially we just had this sort of monthly download on everything in that platform going back to January 2012, but we said what would be really valuable, particularly from that sort of macroeconomic modeling standpoint, is thinking about this over a longer cycle, particularly what we just lived through. So we were able to get them to sort of access their archives and give us a set of data points going back to June of '04, not monthly, but really in a 6-month frequency, and allow us to trace really how much this has changed over time, right? So if you go back to boom period '05 to '07, when every lender and their brother had on offer a no-doc loan and a neg-am loan and loans with those attributes down to very low credit score, you got a much, much larger score in terms of that index. So where for most of the period over which we've been publishing the index monthly, we've been in the sort of 100, 120 range. Our estimate is that in '05, '06, we were at about 800. And '04, which is as far back as we go, it might be closer to a normal market, was sort of a 400 level. Again, a lot of that was driven by the changes in documentation requirement. We're in a full world right now, and again, the weights in our model are really really pretty heavy on those no-doc loans that really are just not available anymore. But this picture, I think, is helpful. I also find it very reassuring that, Wei and Lori and Sam and others, you get a picture that looks not that different from this using different methodologies. So I think that's been very helpful. Okay, let's talk about what have been driving some of the changes over recent months that we've been publishing. Really a divergence between what's happening in the conforming portion of the market and what's happening in jumbo. If you go back to '09, there essentially wasn't a jumbo market without, very, very large down payments. And what we've seen is a fairly rapid loosening of standards on jumbo loans. They're still tight, but now you can get a 5% down jumbo loan. And minimum credit scores have been coming down, so it's not 800 credit scores, it's something less than that. So most of the action in terms of loosening has been on the jumbo side. We've also, really just in the past 6 months or so, begun to see reintroduction of some cash-out programs. So Freddie Mac does a great analysis looking at their data, how many borrowers take cash out of more than a couple $1,000 versus cash in, bringing additional cash to the closing table. That now is looking like you're, because of the home price gains, beginning to see some cash out activity happening again. Modest, but happening. We wanted to have this index in place before some of the regulatory changes related to Dodd-Frank happened, because we thought this would be a nice way of just sort of gauging the temperature of things like what's the impact of QM. It was really a great way to watch it because we could see, beginning in September of 2013, ARM programs begin to leave the market, right? So under the QM, you have to underwrite to the maximum rate over the first 5 years. So that means there's not going to be a lot of value in offering a 3-1 ARM, and we could see those products leave the market very, very quickly. Similarly, there used to be IO available on a broader scale, just not there. And 40-year term mortgages were available to some extent. They've been pulled largely because they're not consistent with QM. Lately, there have been some other changes. Fannie shut down their Home Path program, changes to the FHA 203K program, some construction lending happening, all kinds of neat things. Looking ahead, what are the things that we're really watching for now? Well, some of the announcements made by FHFA, Fannie, and Freddie on providing additional clarity around rep and warrant, particularly for those life of loan exceptions, we think are important. How they're going to show up in this index is that we can, again, see how overlays are changing over time, right? Because we can see for a lender who's operating in the correspondent or broker market, what's their minimum credit score versus what Fannie or Freddie would allow. That's one dimension we can watch that, and it's definitely been coming down over time. Expectation is that would continue. Similarly with FHA, some of the concerns around the treatment in terms of in-depth risk, very similar concerns, and again, we can see changes in overlays occurring over time. One that's absolutely live right now is Fannie Mae announced sort of the reintroduction into the market of 97 LTV programs, and from the middle of last month, what we could see many lenders beginning to offer that. So with our release probably Thursday of this week, will have something to say about what the near-term impact of that is. Fannie announced their 97 reintroduction in December 15th last year. Freddie is in the first quarter of 2015, so something to watch for. And I think that is where I'll end. But thank you. Turn it over to Sam.
Thanks, Mike. Thank you, Lori, for today's invite. We'll look forward to speaking at Urban, and thank you for Urban for the invite. I'd also like to thank Katie Dobbin, who did a lot of the heavy lifting. She's the economist who did a lot of the heavy lifting behind the index. Unfortunately, she cannot be with us today, but she is on the phone. So, quick overview of my presentation today. I'm going to talk about the credit box, briefly sort of the traditional credit box that we look at, some distributional shifts in the market when it comes to underwriting, and then talk about in detail about the index, the construction of the housing credit index, and trends in the index, and then lastly some recent mortgage performance, because it's all about when we're looking at these indices, it's really about the ultimate objective is to get good performance. So let's first take a look at the credit box. So this is sort of the traditional credit box that we look at from a matrix perspective is the LTV and FICO segments. Those are generally the two most predictive elements. FICO, very strong predictor of delinquency, and LTV, very strong predictor of default, i.e. foreclosure. And so what we've done here is for the 2000 origination year, this is the distribution of loans by FICO and LTV. And I'm going to march us forward through time from 2000 to 2005 to 2010 and 2014, so you can see the evolution of the credit box. And it's going to be an automated transition. So the things I want you to sort of focus on is notice how in 2000 how broad sort of the mountain range or the pyramid, as Mike called it before we spoke, how deep they go down the FICO spectrum and the sort of the terrain, how it can be fairly rough, because when we get to 2014, it's going to be very peaked and it's going to be very flat. It's going to look like mountains of New Mexico and El Paso, where I was at a few weeks ago. And so we're going to march forward through time. So here's 2005. You can see the market booms. So there's a huge run up in the conventional market. That's all subprime, and that kills the FHA market. In 2010, the FHA market comes back in its counter-cyclical role. That's why you see that high LTV range really boom. In 2014, FHA has begun to pull back. The GSEs have begun to pick up market share. But as you can see, relative to 2000, which is a more normal underwriting time period, everything is shifted over to the right-hand side of the distribution, so into the very high quality FICO, but also high LTV buckets, which is a little bit odd. So what we're doing is we're really managing for delinquency risk very well, but we've opened up the box a little bit on severity risk. Also notice how flat the rest of the contours are relative to 2000. These are all originations, closed loans, exactly. Yeah.
Sam, what's the vertical axis?
That's just the percentage distribution all in each bucket. So a couple other charts on credit. So here we've plotted the 75th percentile of the debt-to-income ratio, and in early 2011 it was running at about 45%, and it had been going down and loosening. The line that you see on the chart is when QM was enacted, so the market was tightening in I believe in the anticipation of the rule, and then it tightened a little bit more when the rule came. And if you notice the recent sort of expansion over the past 2 or 3 months, not sure if that's a blip in the data or if that's a material trend. So that's something to bear watch. Here we've plotted for credit scores the 10th percentile distribution. So in other words, 10% of the distribution is below, 90% is above. As of January 2000, it was running in the mid-500s. As of today, it's running in the mid-600s. That's a significant increase in FICO space, and particularly when you think about underwriting, which is a national standard, but of course, borrower characteristics are very local. And so when the FICO rate, which is the dimension that underwriting's tightened the most, and when you look at average FICO scores for the U.S. around the country, 660 is not that far off. We're some of the lowest, or some of the weakest credits in the market, which tend to be in the sort of in the Mississippi area, Alabama area, Appalachia, and so I think there's a little bit of a disparate geographic impact when it comes to the tightening that's occurring. So let's talk about our housing credit index. So what we began with a loan level data set. So this is a loan level model that includes our prime, first lien subprime loans. This data set represents about 75 to 80% of all loans outstanding. It covers the market fairly smoothly in terms of products, with one exception. So it covers subprime well, Alt A, jumbo, prime performing conventional, FHA, VA. We cover generally the top 30 originators, covering about 8% of the market. The one sort of weak spot in our data is portfolio loans. So smaller and community lenders and portfolio stuff, we have a quite a bit lower share. So that's the one sort of hole in the data. We use a 5% sample to do the analysis, and once we clean all the data, and it requires a lot of cleaning because we put in 6 inputs that'll go in I'll talk about in a minute. But when we do all the data cleaning, we're left with 1.5 million loans that we look at. So the inputs that we look at, credit score, obviously that's a big one. LTV is another one. DTI, those are sort of the big three classic ones. Broker share, adjustable rate share, so that's interest rate risk that the borrower takes on. It's a big deal. And then the documentation type, totally agree with Mike in our model that comes out. Very, very strong. So what we do is we use a principal components model to sort of reduce all these dimensions. So think of sort of, if you're a kid playing with a balloon, right? And if you think of the metaphor expanding as a metaphor for credit expansion and a contraction for credit expansion. So what determines how big the balloon can get? It's the air pressure that's in the balloon, it's the elevation, the altitude, it's the temperature, it's the material of the rubber and the viscosity. So in the same way, these components drive the credit expansion and then the contraction, and the principal component reduces those 6 dimensions into one single component that we look at. That's a nice and easy sort of summary measure. A few caveats. Let me begin with a few caveats and a brief digression. First, our data goes back to 2000, late 1990s. So we're implicitly assuming that 2000 is a normal underwriting year. If you go further back in time, in fact, AEI at Pinto has done quite a bit of work on this. If you go further back in time into the 90s and 80s, if we had this data back then, I think the picture would look fairly different. So keep in mind that the assumption is 2000 is a normal underwriting year. A few other things we don't talk about at all about appraisal quality, and this is all that's really key in this. And the sustainability of evaluations, for example, is an 80% loan in 2006 really an 80% loan? No. So that's not in this. There's income and occupancy misrepresentation. We're sort of indirectly picking up for the income misrepresentation with the low documentation. I've done some work in the past that indicated that sort of the liar loans in the low doc space exaggerated their income by about 20 to 30%. There's been a couple other papers that do similar work that I know of, and they've come up with, in a very different way, come up with similar estimates on occupancy misrepresentation. Who knows? I personally have never seen anything on that. We also are not picking up simultaneous, or we're missing quite a few simultaneous seconds in this. We know, for example, in 2005 when you saw the big peak in 80 only LP, a lot of those are actually had seconds. In fact, we did some research in the past where we married our loan level data with our public record data, and we discovered that I believe half to 2/3 of the rise, and the 80-only% bucket had hidden seconds behind it. And then also, and Mike sort of touched on this, but credit can be rationed not just by quantity, which is what I'm talking about, but also by price. There's been some literature and research in this space that's particularly interesting that talks about the impact of when there are changes in discount rates, lenders can behave by rationing credit. In fact, if you look at the first announcement of QE1 in November of 2008, the average right after that announcement, the average FICO scores jumped up by 15 to 20 points. DTI moved down by about 4 to 5%. And same with LTV. So underwriting got more conservative after the announcement. So there are all kinds of other sort of confounding effects that we don't pick up in this. So all in all, it's hard to do this. With that, here's our housing credit index, and so it's benchmarked it to 100 in 2000, and we marked it forward. And so a few key points to note here is you can see the tightening, marginal tightening of credit in the early 2000s. That's in response to the recession in late 2000, early 2001, and then you see the really run up in late 2003, early 2004, and the expansion of credit, and it peaks pretty closely to your peak. Actually, I was looking at our chart as you were showing yours, and they moved almost lock in step. And then you see the rapid tightening in credit, and it's flattened out in 2014, and we don't see an improvement in our data at all. So we're not really seeing an increase or an expansion in credit yet, at least when we look from a longer term perspective. So how does the index do when we map against default? So we measured here, I've got the HCI just on an annual basis, so the same data as you saw on the last chart. So the HCI is in the blue area, and it's mapped on the right axis. And then we've plotted the 12-month EPD rate. By EPD, what I mean is 90 days or more delinquent after 12 months for each of those vintage years. So this is analysis. So in other words, the purple pink line measures the 12-month delinquency rate for each of the vintage years. And you can see that the contours move very closely together, but the index leaves the performance, which makes sense. You can see a rapid expansion in 03 and 04. You can start to see a deterioration in credit, but it really doesn't hit until a couple years later. And then the rapid improvement in performance, and in fact, over the last 4 years, the performance has been pristine. It's running at 1/3 or so of where it was in the early 2000s, and that's consistent with the tight underwriting. Here we break out the index into two components, purchase and refi, and the two move together very closely as you would expect. Not a surprise that purchase is more expansion in the purchase segment generally speaking, because 40% of those purchase borrowers are roughly first-time home buyers, so we need a little bit more sort of credit expansion in purchase than you would in the refi space. When we break it out into FHA, into the different loan types, so on this chart we've got FHA, VA, jumbo, prime, conventional conforming, and subprime. So let's first begin with subprime and FHA. So as you'll notice, the change in underwriting for those two segments is not as much as some of the other segments. That makes sense. By definition, they're lower, they're lower credit, so there's less wiggle room to move with. What's interesting is in the jumbo space, as you would expect, purely private market, that's the most sensitive, and that's the one that tightens the most after the recession in the early 2000s, and then expands the most at the peak in 06, and then also tightens the most as of 2011. And as you can see, they're all sort of pretty consistent with each other in the fact that they're all tight. There's a little bit of sort of confounding effect with FHA, VA, because there's a sort of a shift in the composition, because VA is accounting for a significantly larger share of that FHA, VA bucket of the last couple of years. So there's a little bit of a mix shift issue there. Here we've broken out the index by geography. So the nice thing with the index is since it's loan level, we can cut it across a wide spectrum different segments that we can cut it. So here we did it by geography, and this was it. This was a little bit surprising at first, but then not so surprising when we thought about it, in the sense that we know in the Northeast and the West, those two segments have the highest credit scores in the country. So what this indicates is not that the underwriting became looser in those necessarily in geography. Though that is probably true with the West more so than other segments. But I think it indicates the distributional differences of the geography. So as credit expansion occurred in the mid-2000s, you've got much better credit in the Northeast and the West, and so it looks like there's more credit expansion in those geographies, when in actuality, that's not really the case. It's just the distribution of credit scores in those geographies is just higher. This is the last slide, and so here what we've done is what we call sort of hedonic mortgage, or sort of it's the approach that we do similar to the home price space, where we take the same home and we look at the price of a home over time. Here we take this similar mortgage, not exactly the same mortgage, but a similar mortgage. So it's a universe of purchase only, full documented, owner-occupied, conventional conforming, 30-year, credit scores between 680 to 740, and the LTV is less than 80%. So plain Jane vanilla mortgage. And we plot their vintage curves on the left side between 2004 and 2008. And then on the right side, post the credit tightening experience, we look at the performance rates for those vintages. And as you can see, it's much cleaner performance relative to the early to mid-2000s. Not a surprise, but what was a surprise is how much the economy, and not so much a surprise in home prices, but how much the changes in economic growth and unemployment rate really impact performance, even when you adjust for a bunch of the risk factors that we talk about. And the point of bringing up the slide that I think is of particular importance for us is, we're talking about how tight or loose credit is normally relative to a point in time, but also I think it makes sense to also think about it in the sense that the Fed manages or looks at the error rate, or the amount of sort of pain that we can tolerate from an inflation perspective. I think we should be thinking about something like that from a performance perspective. What's an acceptable rate of default that we're willing to accept, because underwriting can manage to that. Clearly we went too far on one side, and now we've gone too far on the other side. But I think it's important to keep in mind that the performance is extremely good. And just to give you some perspective, over the last 10 years, there have been 7.5 million completed foreclosures, and it led to wealth destruction in the order of about 340 to 45 billion. So foreclosure is extremely costly, but it's something that. But one byproduct of the extremely tight environment is that we're now able to avoid many of those costly decisions and behaviors in the past. With that, right?
So ideally, credit availability measures, just like Mike and Sam said, measures the supply side of the credit market while holding the credit demand constant. In other words, credit availability should measure the tightness of the credit box. But that job is not that easy, because credit box is most like a black box. Why it is like a black box? Because there's inside of the box, there's too many players, too many factors, and too many variations. So to distill all the components into a single number, one has to properly weight all the elements and aggregate them into a single number. It seems pretty daunting and impossible for us. So for us, instead of measure the credit box directly, we come up with an indirect but quite intuitive measure of the box, which is how much default risk the market takes at any given time. This measure is very intuitive because the amount of default risk taken by the market, conceptually the market increased credit availability by taking more risk and vice versa. And the amount of default risk taken by the market is perfect as an index because it naturally weights and aggregates multiple risk factors of all the loans originated at any given time into a single number. And this number also is very meaningful. A lower value means the market is taking less risk and credit is less accessible, and a higher number means the opposite. But I want to point out that the amount of default risk taken by the market is not the actual default rate experienced by the market after origination. It's the accepted but unrealized risk at origination. So what's the difference between the two default risk? So the risk accepted but unrealized at origination is all about two things. One is the borrower mix or borrower risk. Another one is the product risk and product mix. And for the borrower risk, you can see a lot of components like credit score, down payment, and debt to income. And product risk is whether there's a payment shocks from the loan products. And this risk is accepted at origination, but how much it realized depends on what economic conditions these loans will go through. So the actual default rate is the realized the default rate, but it has to go through the specific economic conditions. If you want to compare multiple vintages based on actual default rate, because you have different economic conditions, it's not comparable to each other. So what we want to do is basically we want to convert borrower and product mix, which is the accepted but unrealized risk at origination, into a measurable and comparable default risk. So here we have three vintages, and each of them have different borrower and product mix. So our goal is try to convert these three different mixes into measurable and comparable default rate. But how? So our solution is try to apply the same typical economic condition to all three vintages. So first, we simplify all economic conditions into two typical ones, normal and stressed economic conditions. The normal one are the actual economic conditions experienced by loans originated in 2001 and 2002. And the stressed economic conditions are the actual economic conditions experienced by loans originated in 2005 and 2006. Then, for each vintage of loans, we divide the loans into 360 buckets by the borrower and product mix. For example, for the FICO score, we divide into 6 buckets, combined loan-to-value ratio into 6 buckets. And for DTI, it's a little bit different. We first combine debt-to-income ratio with borrower's income documentation level into one variable, then divide them into 5 buckets. For example, if borrower have if a loan have full doc and the DTI is between 0 and 30, put into one bucket. And the low or no documentation loans, no matter what their DTI is, they are in a separate bucket. And For the product, for loan product, we divide them into two buckets, with or without risky features. Loans without risky features include all fixed rate mortgages and hybrid adjustable rate mortgages with an initial fixed rate period of 5 years or longer, and without any risky features like balloon payment, prepayment penalty, interest only, or negative amortization terms. So then for each of the 360 buckets of loans originated at any given time, its default risk under the normal condition equals the actual default rate of the same bucket of loans originated in 2001 and 2002. And the total default rate for the whole vintage of loans under the normal condition equals the average of the above 360 default rates weighted by the volume of loans in each bucket. And the default risk is defined as 90 or more days delinquent and any stages of foreclosure, including terminations due to foreclosure. And similarly, we can calculate the expected but unrealized default risk at origination under the stressed economic conditions. And finally, our credit availability index equals to the vintage's total default risk under the normal condition weighted by 90% plus the vintage's total default risk under the stressed condition weighted by 10%. Why we chose these two weights? It's based on our observation on business cycles in the past 100 years. We found that in the past 100 years, we have about 20 business cycles, but only 2 of them turned into severe housing downturns. So for any of the business cycle in the past 100 years, there's a 10% chance lead to a severe housing downturn. So this table shows part of the lookup table used to convert the borrower and product mix into the accepted but unrealized default risk at originations. I want to point out that here different combinations along DTI, FICO, LTV, and product may have the same amount of default risk. So using this table, we can convert all the borrower and product mix into a default risk number. So before we go to the real results, I want to emphasize that our analysis is focusing on the owner-occupied home purchase loan market. So we basically excluded all the refinance activities. So I'm going to spend next few slides on the quarterly trends of the market from 1998 up to 2013. So this chart shows the amount of risk, default risk taken by the market over the past 17 years. Curve T is the total default risk accepted by the market at any given time. And basically combines both the borrower risk and product risk. And curve C is the borrower-only risk. So the shaded area between the two curves are the product-only risk. So just look at curve T, you can see actually there's 2 peaks over the past 7 years. One is around year 2000. Another peak is between 2000 and 2007. The second peak is much longer and stronger than the first one. And post-crisis, the amount of default risk taken by the market reduced dramatically. It's much lower than both of the bubble period and pre-bubble period. It's less than half of the risk taken over the bubble period, a little more than half than the pre-bubble period. And if we further divide the default risk into its sources, which are the borrower risk and product risk, we can find that it's not the borrower risk, it is the product risk that significantly changes from the pre-bubble period to the bubble period. In other words, the borrower risk is pretty steady between 1998 all the way to 2007, but the product is almost doubled from the pre-bubble period to the bubble period. Post-crisis, product risk is all gone, but if you look at the borrower risk, the level of the borrower risk it takes is only 2/3 in the later years compared to both pre-bubble and bubble period. So it seems to us there's a dramatic over-correction in the market. So how about by origination, by the channels? So this chart shows the government channel. The government channel includes both FHA and USDA loans. Again, the T-curve is for the total risk combines borrower and product risk. C is for borrower-only risk. You can see the government channel, the level of default risk taken by the government channel is basically can be divided into two periods. Before 2008 and after 2008. Before 2008, it's the level of the amount of default risk taken by the government channel is pretty steady. It's around 20%, and the product risk is there's some product risk, but product risk is minimal. After the crisis, the amount of default risk taken by the government channel is kept steady too, but is at a much lower level. It's only half of the amount of default risk it used to take before the financial crisis. How about the GSE market? The GSE market, you can see the product risk from the GSE market is not that big. Before, in the pre-bubble years, the borrower risk is around 5%. At the peak of the bubble years, it's 7%. But post-crisis, this level reduced dramatically. It's around 2% from the GSE market, and almost no product risk. So for the GSE market to recover to its pre-crisis period, just talking about the borrower-only risk, it needs to take 2.5 times more borrower risk than it takes right now. So the remaining market includes basically the PIS market and the portfolio market. This market reflects the private market. You can see both the product risk and the borrower risk increases constantly before financial crisis. For the credit risk, for the borrower risk, it increases from about 6% to 6% in 1998 to 14% in 2007. Double, more than double. For the product risk, which is the shaded areas, it increased from 3% in 1998 to 11% in 2007, almost 4 times bigger than at the beginning of the 1998. Post-crisis, product risk is very little, borrower risk for this market is about 3.4% in 2013. Our index also shows that the three markets, the GSE market, the government market, and the PLS and portfolio market, they have different responses to housing downturns. If you align the amount of default risk taken by each of the market with the housing price appreciation rate, you will find that the PLS and portfolio market has the promptest response to the housing market changes. And the GSE market and the government market has delayed response. They lag by 5 to 6 quarters. So this is our credit availability index. It's based on origination information. It reviews very interesting change about the market, but it's not perfect. It has some limitations. First, because we only look at the origination stamp, but the credit availability is about a complicated process. So if we formally define credit availability, it is a probability. It measures the probability that a consumer with a need for credit can secure a loan at a given time. And this probability depends on two steps. So let's see here we have 100 weaker applicants and 20 of them receive loans. So there's a denial rate over there, which is 80%. 80% applicants are denied for mortgages. But this alone is not a complete picture. There's another section. Let's see if we have 200 weaker consumers with credit need, but here only 100 only 100 of them did submit their applications. So the remaining 100 weaker consumers with credit need are basically deterred. So there's a deter rate of 50%. Going back to the previous slide, we talked about this probability. So using this slide, we can see that at the top of the chart, we have 200 weaker consumers with credit need, but at the bottom, only 20 of them receive loans. So the overall progression rate only equals to 20 divided by 200, which is 10%. So the probability basically depends on two rates here. One is the denial rate, one is the deter rate. Why, you probably notice here I keep saying weaker consumers, weaker applicants, and weaker borrowers. Why is because traditionally, for example, the denial rate, we calculate denial rate of all applicants. It includes both weaker and strong applicants. So that gives sometimes give us very counterintuitive patterns, just like Lori showed at the beginning of the presentation. Shows that the traditional denial rate shows it's higher in the boom years, but lower in the post-crisis. That's only one striking counterintuitive pattern. Another one is if you plot two denial rates. One is for the government channel, another one is for the conventional channel. You will notice there's a crossing between the two curves. The crossing happened in 2009. Before 2009, the government always had lower denial rate than the conventional channel. After 2009, the government channel actually has higher denial rate than the conventional channel, which means the government have tighter market than the conventional channel, which is apparently impossible. Why? So what explains this counterintuitive patterns is just because when we calculate denial rate, we included both the stronger applicants and the weaker applicants. So the traditional denial rate reflects both the tightness of the market and the composition of the applicant pool. So in the past year, we come up with a new and better measure of the denial rate, which measures the denial rate exclusively for weaker applicants. The reason people traditionally only include all the applicants when calculating denial rate is because there's an analytical challenge. You don't know, researchers don't know applicants' credit profiles. So I don't have time to go through all the details of the methodologies, but you can find the interesting results in our papers. Thank you.
I want to thank all three presenters for three really, really great presentations. That was very, very interesting. We're now going to start the question and answer part of the talk. If you have a question in person or on the web, please identify yourself by name and affiliation. Also, for those in the room, please be sure that you turn on your table mic and speak into the mic. And webcast viewers are welcome to submit questions again at events@urban.org. Again, events@urban.org. So I want to thank those of you in the room for coming and those of you for dialing in as well. Any questions in the room? Yes, Mike?
Thank you. Mike Krell. I'm currently an independent consultant. I guess I have three questions, and I'm not sure who to direct these to. And maybe these are partly a misunderstanding of what you're trying to measure, but I think broadly about credit supply conditions. And if I were, say, at the Fed and thinking about the transmission of monetary policy from my portfolio to the Treasury market to mortgage market conditions, some questions would arise. One about rate spread. I'm not sure that, if I understood any of these measures, they would directly reflect changes in the intermediation process or whatever that affects the spread between, say, Treasury yields and mortgage yields. A second question, maybe relating to where you're doing a survey of lenders or investors. Let's say in one market there are two large lenders, and one decides to tighten up its standards and, in essence, pricing itself out of the market, but the other one's still there at the same terms as before. Would your measures capture this as a tightening, even though everybody could perhaps go to this one that did not raise its standards? And then third, I guess the question of what I broadly characterize as transactions costs. That might involve the burden of the application process, maybe the length of time it takes to get through it, and so on. Those are things that one anecdotally hears people complaining about and could be broadly characterized as credit supply conditions, availability. How are these factors captured or not in these various measures?
I can start. On your first question of whether we're capturing any rate spread or pricing information, we're not in this measure. This is just our loan programs with certain terms available to the market. Then to your second question, we are absolutely capturing a difference between, is it one investor offering this program, 2 or 10? So I completely agree with you there. I think that's important, and I think that also has an impact on the first question, because if you only have one investor out there offering a particular program, they obviously would have more pricing power than if you had 10. So I think there's a relationship there. On the third part, I can completely agree that is a fundamental different feature of today's market relative to the boom market, and that is a much higher transaction cost experience. We kind of capture that by focusing on documentation requirements as one dimension for the weighting matrix. But we don't have anything that would directly capture it, like, time, blood, sweat, and tears spent in the application process.
I'll go ahead and take a quick stab, and begin with where you ended, which is, we also pick up documentation, but, so we're picking it up very indirectly, but not directly at all. In terms of credit spreads, so as you recall, one of my caveats is, we're looking only at the quantity and not price, so we're not looking at prices at all. But we've been doing some work very recently where we look not at credit spreads the way you sort of define them, but looking at the heterogeneity of spreads between lower credit borrowers and higher credit borrowers, and it turns out that the spread compression in rates. So we're looking at, for example, we look at the 95th and 90th, and then the 10th and 5th percentiles of rate by FICO dimension. And so it's not a surprise that while there's been a tightening in quantity space, there's also seems to be a tightening in price space, if that makes any sense.
But again, I think there's some drivers for that, right? One that you have with the GSEs, or loan level price adjusters, really are setting almost uniform credit pricing in the conventional conforming. And then you have some new regulatory constraints which put additional hurdles for a pricing spread beyond a certain level.
So my personal perspective on the pricing side, I think neither of us are looking at the pricing of the market changes on that. But I think talking about credit availability, we have two stamps in the market. The first stamp is whether you approve or not approve a loan. Once you approve the loan, then you assign some pricing and initiate some pricing negotiations between the borrower and the lender. So in my view, credit availability matters the first stamp, whether you open the door at all, rather than how much you price your product. And there's another thing, actually mentioned in Sam's slides, that quantity doesn't mean good things, especially if you look at the boom years. Credit is much accessible than now, but I don't think we want to go back to that direction, because that leads to a lot of default. So there's a balance you need to keep between quality of the loan, credit accessibility, and market stability. So all these things need to be tied together to assess the health of the housing finance market. So
just one last thought. I think your transmission channel sort of stream of thought is exactly sort of where we're going, where I mentioned the reintroduction of the 97 LTV program. What we can see in ours is, given that Fannie made this determination, how is that being propagated out through the market in terms of lending offering? We may see no borrowers show up. We don't know. We'll find out 6 months to a year, but we will know what was on offer in the market.
One quick comment, that your pricing question is fascinating, because I think it also brings to light that there could be some policies that are working at cross purposes, because there's been some work by the Fed that's shown that when rates fall, there's a ratcheting up of credit. So we've got QE that's trying to pull down the cost of credit, right? And that was a big step for the Fed, because they're stepped into sort of asset allocation perspective, where they favored one asset class versus others. But then on the flip side, the reaction by lenders has been to tighten credit, right? So it hasn't helped those who need it the most.
Yeah, one comment on the transaction cost is, I think transaction cost is not limited to the lender side. Eventual lender will, transmit back to the borrowers. So if you think about that transaction cost transmitted to the borrowers, a lot of potential borrowers actually are deterred because of that increased transaction cost.
Yeah. I was actually going to make one other comment as well, and that is, when you look at the refinanceability of the mortgage market, it's much, much less than it ever has been in the past, even going back into the 90s, in part because of the high transaction costs. Actually, I want to follow up on your 97 LTV comment, because we actually got a question from the web. Could Mike Frattantoni elaborate more on what he said about more lenders offering the Fannie Mae 97 LTV product? How many are offering it compared to the previous month, which was presumably 0?
Yeah, so the Fannie Mae made their announcement on December 15th. That was the implementation date. And we will be coming out with our December data on Thursday. And with that, we'll identify what portion of lenders in the month of December were offering such a product. It was a significant portion.
Great, thanks. Mark, and then Barry, and then,
So to follow up on that, maybe you can elaborate a little bit, because much hay was made about 97 products. But ultimately, what I think really is going to happen in the market is will be a substitution by consumers seeking those products from, say, an FHA loan to a GSE loan now that that program is available, particularly if the pricing is better. So isn't that really, from a market perspective, has credit really been made more available, setting aside price? I mean, people can get 98 LTV loans. They can now get 98 LTV loans from more lenders with more programs. Does that change credit availability, or is that really changing the pricing of that point, of that credit point?
No, I think it's definitively making it more available. The magnitude, I think, is up for debate, and we're going to find that out, right? But there are areas where FHA loan limits are below GSE loan limits, so that's a clear incremental addition. If you look at the way the market's broken, it typically has been by credit score, where for many borrowers it is a lower price to go with FHA for a lower credit score, better price for a conventional institution for a higher credit score. So quantity versus price, but
Yeah, that's a demand response, though, not a supply response.
And also, I mean, to have a full picture, you have to also think about mortgage insurance market, how expensive that market is. So,
again, price.
Yeah.
Right?
That's right.
I mean, here's where I'm not trying to put anybody on the spot, but it really makes it tricky to distinguish between the supply and demand side and quantity versus how much you made earlier was really what we're trying to do is trace out the supply curve at all different price points, right? Theoretically, as economists, we would say, well, given any price, I'll lend to anybody. But the reality is what's really being done by everyone up there is we're trying to find the thresholds where people won't even go because of, there's usury terms and things like that around pricing that kind of risk, right?
I mean, you bring up a good point. I mean, if you look at demand, if you look at purchase applications data, if you look at purchase applications in 2013, according to the HMDA data, they're about the same levels they were back in 1993, without any kind of demographic adjustment. Now, of course, there's going to be some that are deterred. I love that term. It's hard to quantify that. But that's happening. If the Fed put out a survey, the New York Fed put out a special module on housing back in September that asked renters, what are the obstacles, top 10 obstacles holding you back from buying a home? Underwriting was not in the top 3. Income was number 1.
It's certainly going to be an area that's going to prove very fruitful for further research, and a lot of people are going to be looking at the difference between in areas where FHA loan limits and GSE loan limits differ, and look at the incremental effect. That's, we're going to probably have 3 or 4 papers on that in the next year. Barry?
Just one quick comment on Mike's question. I mean, from the point of view of the mid-'90s and of the early 2000s, what you just described is exactly what happened. Fannie and Freddie sort of basically shifted very high. FHA share shifted to very high LTVs, right, as Fannie Mae and Freddie Mac came in behind them. Raphael Bosco's doing some work on that, so incrementally it really didn't make a difference. But I do think from a consumer point of view, it's really important that different lenders participate in these programs. And the question of consumer choice, right, and variability of products is one of the things not picked up in here, right, but is important from a consumer point of view. I had 2 questions. When I looked at your 360 buckets, I couldn't help but think, well, I used to see charts like that as people in Fannie Mae were describing their automated underwriting to me, so, and others as well, total and so on. So I was wondering if you've done any kind of comparison or consulted with them about their modeling, which I think tried to look at very similar. That was one question. And Mike, on the price question, mortgage origination has always been a very low margin business, at least that's what lenders always told me. And with all of the increased regulatory costs and other things, it's even more so. How much are you seeing in the market of lenders just simply not having the same appetite for mortgage lending at any level, and therefore only looking for the best credit quality, and the impact that's likely to have on mortgage availability? So only two questions.
So first, we have in contact with GSEs to compare our lookup tables with their underwriting on pricing sheets, and our intention also is not reverse engineering the automatic underwriting. So, but I think this market, just talk about pricing, is not a totally risk-based pricing system yet. We want to move to that direction, but the reform hasn't happened yet. So that is important. But also you point out that not necessarily you have higher expected default rate, you will be priced higher, or vice versa. And also, just like what I said, in the market, I think it's two steps. First, whether you open the door or not. The second is the pricing. So how these things tie together to that lookup table, I think deserves further study on that.
And on the question on lender profitability, so we have data that comes through the Mortgage Bankers Financial Reporting Form we put out as our quarterly Mortgage Bankers Performance Report, looking at lender revenues, lender expenses, lender profitability. And what's really changed the past couple of years is the expenses have really increased very sharply. So a couple of years ago, on a per loan basis, think $4,000, $4,500. First quarter of 2014 was $8,000 per loan. It came down. That was a very low volume month. Now it's still about $6,500 per loan. Looking inside of those expenses, it's really telling. It really is additional personnel expense in the back office of a lender shop. So these are quality assurance, risk management, compliance personnel that are now an additional fixed cost to being part of this business. Some of that coming from regulation in capital, some of that from trying to defend against repurchase risk from Fannie and Freddie, indem risk from FHA, really sort of bulking up on their staff. That is completely counter to the way the mortgage business typically runs, right? I mean, think about the mortgage industry that in 2003 did $4 trillion in volume. Last year did a little over $1 trillion, right? It is an industry that sort of screams for a variable cost model, and it is being loaded up with fixed costs. So what is happening as a result is a lot of consolidation of various, so particularly some smaller banks just leaving the business just because this is no longer something where the risk reward makes sense. Just to give you a hint, we put on a mergers and acquisitions workshop last fall, and it was one of the most popular things we did. So there's a whole lot of consolidation in the industry right now to try to handle these fixed costs.
Bernie Mercy, consultant. A lot of good points have been made about the 97% LTV and don't want to beat it in the ground. I'm assuming that all the measures would show slightly more credit availability / increased risk. So more for a clarification for Wei, does the change to the 97% LTV credit or your product? The distinction you make between those two curves, where does it show up?
It's in the borrower bucket, in borrower risk bucket. So, but again, there's a lot of collinearity between the higher LTV and risky products. A lot of risky products, they have, let's see, one loan have prepayment penalty, all have negative amortization. It's also have a higher chance being high or much lower down payment. So you can't. So what we do is we first look at look at use these buckets to put into the lookup tables, which is the lookup table for loans with risky features, and then put all the loans, include actually the received risky products, put into the lookup table without risky products, kind of assuming all loans received no risky products. So with that, we calculated the borrower risk versus the total risk and so on and so forth.
In fact, what's interesting about the way you broke it out is you got borrower risk and product risk. I would add there's another line embedded in your borrower risk, which is collateral risk, right? That's what you're talking about, and that's, I think the 97% LTV product availability today is interesting because home price volatility today is twice the level it was just 10 years ago. So I think the availability of the low down payment product is particularly interesting today because home price volatility is much higher. So I'd be very curious to see how they perform in the future relative to that type of product in the past.
The other context to keep in mind with the 97 is Fannie only discontinued their 97 in late 2013, right? So in terms of our index, it'll be interesting to see how things compare then in terms of lender take-up of that program relative to lender take-up in 2013 when Fannie was still making it available.
One clarifying question for Mike about the MBA's Mortgage Credit Availability Index from Leonard Kiefer at Freddie Mac. How did changes in the number of institutions affect the index? If, for example, 2 institutions merged, would it show up in the MCAI as reduction in credit supply?
It would. There are other aspects of that. So, for example, when Fannie terminated their Home Path lending program, again, that propagated through a large number of lenders making the same change at the same time, and so you saw a drop in the fall of last year. But yeah, consolidation in the industry would show as a decrease in our index.
Louis?
Hi, Louis Crowe with Freddie Mac. So, as some of you have, so all of you kind of showed the same picture, which is a normalized availability rate around 2002, spike in availability and the boom, and then a real contraction. If you're talking about going back to a more normal time, 2001, 2002, now there's new regulatory constraints around, especially notably QM, which is going to restrict all of the, the low DOC, the neg-am products, and a lot of the DTI borrower features. So have you tried to assess what a normalized credit availability would be subject to constraints of QM?
I will start first, Jim. So just like we divide the total risk into 2 groups, the borrower risk versus the product risk, and you're talking about the constraints, the legal constraints in the market. I think most of the legal constraints is focusing on the product side rather than the borrower side. So I think it's going back to the normal years, even talk about recover the borrower risk from the current level to the normal years, still we have a long way to go.
But DTI would show up as a borrower attribute in your model, wouldn't it?
DTI, yes. DTI, yes. Yes. So there's some, the legal constraints has some, but the legal constraints doesn't mean lenders cannot provide those loans and borrowers cannot accept those loans. It just means there's some constraints over there, and it depends on the second market, how the second market and how the borrowers utilize those products.
But we've not tried to come up with a new number, new normal, but completely agree with your point that particularly for a self-employed borrower, it is a very, very different market than it was even in a more normal time like 01 or 02, which was really the impetus for a lot of the low doc programs, was to be helpful to a low doc borrower in terms of letting them have a view on what their normalized income looks like.
Good question. Have not adjusted for it, but if you recall from the jumbo line that I showed, that's the market that reacted the most, both during the boom and the contraction. In fact, the adjustment process in the purely private space was much faster than any other. So I agree.
You showed that too.
Yeah, I wouldn't expect it to come back anywhere near what it was before due to that.
We have time for one or two more questions. Hey.
Automated underwriting sets cut points, so whether it's in a guide and it says there's a product available for 97, it doesn't mean that they may have an accept rate of 20%, 10%, 3%, that's part of the black box I think you mentioned. Is there any way to capture or know or understand more about sort of the implications? It's being offered relative to a guide or handbook is a relatively easy thing, not counting for price or automated underwriting.
Right. So I think part of the answer, as I said, this is going to be one tool that you have, and many times you're going to want to use it in combination with transaction data, right? And so if you know that a lot of lenders are offering a loan program of a particular type and no one's taking them up on it, that's a signal that it's either a pricing issue or some other demand issue, income, student debt, what have you, anything else that's impacting a lot of the description so far has been first-time home buyers not showing up in an environment where there's tight credit. This is now an ability to try to tease those two apart using what we provided, what these guys have provided, and other information.
Okay, so if you just track over time and then see what the
Right.
implications. The only other thing was house price. You know, I understand sort of why house prices are handled, particularly in your model that focuses on default rates. Like a lot of the early models, those built in very high percentages back in the day, not considering like stress, but even in normal conditions, like 8% in large numbers such as that. And clearly there is a lot of volatility. So I'm curious, particularly in your model way, about how sort of you deal with that kind of house price variability and price effect relative to your measuring default.
So we simplify all the economic conditions into two typical ones, the normal and stressed conditions. And our index basically look at the weighted scenarios, assigning 90% to the normal conditions, 10% to stressed conditions. Then we look at the trends. And we also examined the trends under this typical conditions separately. We compared the three trends over there. The general trends are almost similar. The only significant difference is the product risk is amplified if you apply the stressed conditions. So talking about the general trend, I think the economic conditions is not that important. So that's my thought.
Okay, Yvette, thank you all very much for coming, and I'd like to thank the speakers for doing a great job. Our next event is an evening seminar co-hosted with CoreLogic here at the Urban Institute on January 22nd, and our topic is going to be mortgage insurance, premiums, capital, and accessibility. Our next day to talk is going to pick back up in late March or early April. We'll keep you posted with the date. So remember, January 22nd, evening talk, 5:30 to 7:30 on mortgage insurance. And thank you all for coming, and a special thanks to our presenters for doing such a great job. Take care.
Good job.
Comment about, I think about her.
That sounds good.